The Biden administration announcing new investments to trim the cost of EVs.
GM CEO Mary Barra surprises the automotive industry by announcing a departure from electric vehicles in favor of hydrogen fuel cell technology, challenging the current electric vehicle trend. Today, we're going to discuss the warning to all EV makers by the GM CEO. If GM's transition proves successful, it may encourage other manufacturers to rethink their strategies. GM's emphasis on hydrogen aligns well with markets such as Japan and Germany, creating opportunities for international collaborations. A move to hydrogen could offer various advantages, addressing common consumer concerns associated with electric vehicles, including extended charging times and range anxiety. However, the environmental implications of prioritizing hydrogen raise questions about the carbon footprint linked to its production. GM's decision may leave early adopters of its electric vehicles feeling neglected, raising worries about resale value and longevity. It's crucial for GM to proactively address these concerns. The future of automotive competition may pivot towards factors like energy efficiency, refueling times, infrastructure availability, and environmental impact, ushering in an era of dynamic innovation. GM is changing its emphasis from electric vehicles to hydrogen fuel cell technology. This shift by GM towards hydrogen could lead governments to reassess their policies, potentially introducing incentives for hydrogen vehicles and boosting investments in hydrogen-related research and infrastructure. Energy efficiency, refueling times, infrastructure availability, and environmental impact are expected to become crucial factors influencing competition in the automotive industry. As a consequence of GM's pivot to hydrogen fuel cell technology, there may be advancements or revisions in the storage, transportation, and refueling processes for hydrogen. GM's dedicated focus on hydrogen fuel cell technology has the potential to reshape the automotive industry by ushering in a dynamic era of innovation among various companies. Transitioning to hydrogen fuel cell vehicles, FCVs, has the potential to tackle the prolonged charging times and range concerns associated with electric vehicles. This shift could drive advancements in FCV technology, fostering more efficient fuel cells, innovative storage solutions, and cost reductions in the production of green hydrogen. GM's commitment to hydrogen FCVs might incentivize other companies to invest in hydrogen research and development, although it comes with financial risks and environmental considerations. While GM's move towards hydrogen technology may raise concerns among early adopters of their electric vehicles, the company is committed to addressing these worries. GM plans to educate the public about the benefits of hydrogen, make necessary adjustments to their supply chain, and explore potential collaborations with new partners. GM's incorporation of hydrogen as an alternative to electric vehicles has the potential to reshape government policies, encourage incentives for hydrogen vehicles, and ignite innovation within the automotive industry. Amidst signs of increasing inventory and sluggish sales, executives in the automotive industry acknowledged this week that their ambitious electric vehicle plans face uncertainties, particularly in the short term. Top-level leaders at major car manufacturers expressed fresh concerns about the growth of the electric car market, with doubts about the feasibility of these vehicles putting their multi-billion-dollar electrification strategies at stake. During GM's recent third-quarter earnings call, Barra and the company adopted a more cautious stance. GM disclosed in its quarterly results that it is abandoning its targets to produce 100,000 EVs in the second half of this year and another 400,000 by the first 6 months of 2024, without providing a specific timeline for achieving these goals. Dealerships burdened with growing inventories are grappling with prolonged selling times for EVs. Despite attractive markdowns and discounts, executives are finding that these vehicles take longer to sell compared to their traditional gas-powered counterparts. The market is experiencing a shift where potential buyers are increasingly focused on cost considerations, infrastructure challenges, and lifestyle barriers to EV adoption. In response to diminishing demand for electric vehicles, manufacturers are acknowledging this reality, with Ford being the first to adjust its plans. Dealers rejecting Mach-E allocations prompted Ford to extend its deadline for achieving an annual EV production of 600,000 by a year, and abandoned the 2026 target to build 2 million EVs. Reflecting this industry trend, Honda decided to discontinue its collaboration with GM to co-develop sub-$30,000 EVs. Honda CEO Toshihiro Mabe cited the challenging and evolving EV landscape as a factor in this decision, stating that after a year of study, they found it difficult as a business and are thus ending the development of an affordable EV, as per an interview with Bloomberg. While EV sales continue to rise, they do not meet the anticipated demand envisioned by companies that have invested significant sums in the EV sector. The anticipation of enduringly higher interest rates has prompted companies to adjust their plans cautiously as they approach 2024. The chief financial officer of South Korean battery maker LG Energy Solution, Lee Chang-sil, expressed concerns on Wednesday about the potential for lower than expected EV demand next year due to global economic uncertainty. In line with this trend, Honda and General Motors announced on Wednesday the termination of their $5 billion joint plan to develop more affordable EVs, just a year after unveiling the initiative. GM, acknowledging the altered landscape, announced its decision to prioritize meeting EV demand in the near term instead of adhering to specific volume targets. Responding to the revised outlook, investors have shown a notable shift. Over the past 3 months, the iShares self-driving EV and tech exchange traded fund has seen a significant decline of over 24%, surpassing the 8.3% fall observed in the MSCI All-World Index, a global equities proxy. Electric vehicle sales are experiencing growth, with the United States seeing over 300,000 units sold in the third quarter, as reported by Cox Automotive. In September, EV sales rose by 14.3% in the European Union and by 22% in China, which is the world's largest EV market. Tesla CEO Elon Musk emphasized during Tesla's earnings conference call that the majority of car buyers focus on the monthly payment, and if interest rates remain high or increase further, it becomes more challenging for people to afford purchasing a car. Additionally, cobalt metal prices on the CME have decreased by 20% this year, and more than halved since May of the previous year. In response to the changing landscape, U.S. automaker Ford recently announced temporary cuts to one of the 3 shifts at its plant producing the electric F-150 Lightning pickup truck. In July, Ford also slowed down its EV production ramp-up, redirecting investments toward commercial vehicles and hybrids. Shares of Japan's Nidec experienced their most significant drop in 15 years, declining over 10% due to investor concerns about the motor manufacturer's prospects in the increasingly challenging Chinese market for EVs. Nidec is now anticipating a $15 billion full-year loss in its key e-axle business, contrary to the previously expected profit. E-axle manufacturing involves combining motors, gears, and power control electronics. That's all about today's video. If you like this video, don't forget to like and subscribe to our channel.